in progress. I want to start by call the meeting to order at 5:46 and the accessibility statement. This meeting is accessible to people with disabilities. Microphones or telephones will be used by all speakers. Large print materials are available upon advance request. If you would like either of these accommodations, please contact Mary Waldron at 508-583-1833. We also read the Notice of Non-Discrimination Rights and Protections to beneficiaries with regard to federal Title VI non-discrimination protections and the state non-discrimination protections is posted in this meeting room and is available on the Old Colony Planning Council website. Please contact Mary Waldron at 508-583-1833 for more information. Thank you. Okay. So we don't have Mary on the call right now. So Megan, can you help with roll call?
Yep, absolutely.
Okay, thanks.
So we're doing it where if you are a delegate or an alternate, just say delegate or alternate and whether you're present or not, just for this first time around. Abington.
Delegate present.
Thank you. Avon. No. Bridgewater. Sandy should be coming late. Brockton, I know, is not on. Duxbury. Oh. East Bridgewater.
Alternate present.
Thank you. Easton. Halifax. Hanover. Hanson. Kingston.
Delegate present.
Pembroke.
Delegate present.
Plymouth.
Delegate present.
Plimpton.
Delegate present.
Stoughton. West Bridgewater. Whitman. And delegate at large.
Delegate present.
All right, thank you.
Thank you, Megan. The first action item is the February 21st, 2023 meeting minutes. We've all received those minutes. Does anyone have any comments or does anyone have a motion to accept the minutes?
Lee Hartman, I'll move to accept the minutes as presented.
I'll second that.
Thank you. Since we're on Zoom, Megan, can you do a roll call vote on that?
Absolutely. This time you just need to say accept. Abington.
Accept.
Avon, I don't believe is here. Bridgewater is not on yet. Brockton is not here. Duxbury is not here. East Bridgewater is not here. It's everyone at the bottom of the pack. Easton, no. Halifax, no. Hanover, Hanson, Kingston,
Accept.
Pembroke,
Accept.
Plymouth,
Accept.
Plimpton,
I'm going to abstain.
yep. Stoughton, no. West Bridgewater, no. Whitman, and delegate at large.
I'm gonna also abstain just because I didn't attend.
Great, thank you.
Megan, just a note, East Bridgewater, I'm the alternate, John Haynes. So I'm present, but I wasn't there, so I should
Oh,
abstain.
thank you, thank you.
Thank you. So the next action, do we have Rockland Trust on with us right now? Do we have Barbara Howard and Brian Callow?
Yes, you do.
Yes, you
Oh, hi, now I see you. So we're going to take things out of order and go forward with the OPEB presentation from Rockland Trust, and we'll come back to the February financials.
Excellent, thank you. And how much time do you have allotted for us? I don't want to keep you too long.
We don't have a specific time frame. I think it depends on whether people have questions for you. But I think it's important that we get an update on what's going on with our OPEB accounts in such a crazy market.
All right, so we'll try to keep it to 20 minutes and allow maybe 10 minutes for questions. Would that be too long?
Yeah, as tight as we can, but
Okay.
I think people will be interested.
All right, awesome. All right, if you could just turn to page 2 of the presentation. Again, I'm Barbara Howard. I'm the relationship manager on this account, and we thank you all for letting us come and present to you this evening. I'm going to take you through the relationship review, which is on this page, the OPEB planning steps and where you are. I'll then turn it over to Brian, who is the portfolio manager on the account. He will go through the allocation and the performance, some market commentary, depending on how long we've gone, and the portfolio holdings are included, but they're just there for reference in case there's any questions. So the next section you can see on this page is when the account was opened. It was opened back in December of 2012. The investment objective is balanced. And again, Brian will review that. We've included the fiscal year additions throughout since inception. So if you follow that line item over towards the right, you can see the total additions to the account total 695,000. The market value as of February 28th was just over 900,000. I do have the authorized signers currently as Christine, Douglas, and Sandra. Is that still correct?
No, we'll have to take that up offline because we have had changes in officers.
Excellent. I will
And
reach
I know
out.
we've
I'll reach out to-
changed other accounts, but not this one apparently.
Okay, all right. I can, should I reach out to you, Becky, or Brenda?
Brenda,
Okay. I will reach out to her to get that updated. I have your auditor as Guider Hurley, and then Odyssey Advisors is your actuary on the OPEB. The final line item on this page, you can see the fees. There's various breakpoints. So currently the annual fee on this account works out to 57 basis points. And then on the next page, this is what we call our OPEB planning step. So you adopted the language of the Mass General Law pertaining to OPEB back in 2010. As far as I know, there is no formal trust agreement. There is an investment policy on file. It was last updated in January of 2016. And currently the funding policy is $5,000 a month. And then the payments right now, you're paying what we call pay as you go, meaning you're paying your retirement plan costs outside of the fund, as most of our municipalities do, and not really going to tend to use the funds until it gets fully funded or closer to fully funded.
just a note here, we did spend quite a bit of time last year developing a trust agreement. And we're in the process of implementing that.
Oh, okay.
So we've worked with, I'm blanking on the name of the law firm.
Murphy, Hesse, Toomey, and Lahane.
Great.
Thank you, Charlie. Murphy has seen to me.
Excellent. I'll make a note that that's in process.
Thank you.
And then if there's no questions on other questions on that, I'm going to turn it over to Brian.
Great. Again, thank you for having us. And we appreciate your time. Any questions at any time? Well, it's harder, you know, when I'm there, you just put your hand up if you're here. If I see you waving, I will. I can only see a few people, but and certainly after, I'm happy. Any questions? We always want to know what you're thinking more than what I'm just talking about. One thing I'm guessing that a lot of people are thinking in general, whether it's here or not, it's how's Rockland Trust doing in all this bank noise. So I will take a minute to kind of to chat about that before I go into the portfolio itself. First of all, the portfolio is not held on the bank's balance sheet. It's held in essentially electronic nominee name at a custodial or a third party. So in no way, shape, or form are your assets ever involved with anything in the bank. That said, when you compare Rockland Trust versus a Silicon Valley or a Signature that went, that met their demise, went out of business. What I would put is when you think of the business they were in, you had Silicon Valley and about 51% technology business. You think of Rockland Trust, we're in your business and your neighbors, etc. So very different clientele. If you think of the way they measure diversity of deposits is essentially what are your percentage of your deposits that are held by people less than 250,000. So you have breadth of it, not one person just can't pull out all their deposits. Of the top 100 banks in America, we are number 7, Rockland Trust. Silicon Valley was number 99, Signature was number 96. So much different banks in that regard. Also, if you think of the number of clients, Silicon Valley had about 173 in deposits. So when they started unraveling with about 40,000 clients. Rockland Trust has 15 billion in deposits, and we have about 300,000 clients. So much different bank, much more secure. They got a lot of hot money in. So their balance sheet, they had upward of 53% of their assets sitting in fixed income securities when rates went up, bond prices went down, as we've kind of talked about here before. So that was when then they immediately had less capital and needed infusions. Rockland Trust had about 16% of their assets in their portfolio. So very much more secure bank. So if anyone asks you, those are differentials that are out there in the system. Rockland Trust is very strong, ready to go. And I said, on top of that, our assets are measured, held away. But I wanted to make sure that since you're one of your neighborhood banks, that you guys all knew that. Switching to the portfolio, as you can see here, it's a balanced type portfolio, and that's on page 4. It's not meant to be, overly, yep, right there, and not meant to be super glossy. As you can see, most of if you're colorblind, I bet you as the hands of the clock, and almost 90%, 70% of it looks the same. But if you think of it, what the balanced nature is, it's essentially 55 stock, 45% bond. So you can see that first 30%, or if I looked at a clock on that pictorial side of the right-hand side, from 12 to about 4 o'clock, that's the large cap equity exposure. So that's the Microsofts of the world, the Pepsi's, all those are the largest multinational companies out there based in the US. The next portion, and again, these are usually about 30. If you think what happened with the market last year, there were obviously some undulation. That's core fixed income. That's investment grade, the US fixed income. So treasury, agencies, mortgage-backed securities, all things that, again, are investment grade, high quality. And then from there, we diversify the portfolio because we want to be invested in everything globally, and also with capitalization. We want different size stocks in there because they can move differently with different parts of the economy. Same thing with fixed income. We have fixed income assets in here that are different than that 28.8%, because we don't want all fixed income assets to hang on every word of the Fed, if you will, meaning I'm going to do that teeter-totter again. You think of it when core bonds, or what the Fed moves, investment grade, when the Fed starts lifting interest rates, prices drop. They move inversely. Same thing. So for the last 10 years prior to that, bond rates had been going down, bond prices were going up. We had the wind at our back, and then that's why rates were so low for so long. So it was a real spike. Not only, when I say spike, we use, the term is being thrown around a lot, but the old 100-year storm in the treasury bond market, it was the 100-year storm in terms of volatility or movement. The Fed's moved rates about 75 basis points 4 times prior to that year. Yes, last year they moved 4 times in last year. So very much about the most you're going to see interest rates. Well, I won't say, because I can't profess to see what's going to happen in the future, but that's about as much as we've seen, even in the 80s, or when we had that hyperinflation. How much interest rates moved? That was higher than that, and more of a dramatic hit to fixed income. So that set the backdrop. Obviously, we started with war too, so the equities and the bond market got roiled by that. And I have slides in the back if we want to cover more questions. But the balance usually, or oftentimes, and this is why I want to talk about that the rates moving like that, is people always say bonds and stocks move, and they move inversely as opposed to just interest rates and bond prices. It's not necessarily true, as we witnessed last year. The reason for that is people think of, bonds go the opposite way to stocks. Well, that happens because when things go, but I'm going to use a very technical investment term here, bump in the night, when we get something that really jars us or scares us, they call it a risk off trade. But essentially what happens is people leave risky assets and they run to comfort zone, and that's usually treasury securities. And that's why people always think that they move inversely. It's more just a nervousness or a risk off trade where people run to safety. In this case, what happened what reason why it doesn't happen as much as people as right in line as people say is because if you think of the normal cycles of the economy in the stock market, we used to say about every 10 years the market cycles. It changed when the government put so much money in 2008. We had an extended run up, but certainly through time, you normally get this kind of ebbs and flows or booms busts of the stock market. Rolls up, or you come out of a recession, everyone goes buys a fridge, a car, and then we find out in the economy grows at 3.4% coming out of it. We spend all our money, and then we got to go back in a recession and then figure it out all over. Interest rates, however, were last as low as they were, last year and prior, coming out of 1942. So in 1942, they were at a similarly low level, climbed all the way into 1982, and then dropped down here to really call it, 2022. So you got bonds moving in 40-year increments and stocks in 10. So that's why I don't want everyone, you can put people in their place when they say, oh no, stocks and bonds move inversely. They do not. It just seems it's more of a when things are at most stress. So having a balanced portfolio, and that's how I build to this, is normally you say, okay, we've got that mix of half and half. When bonds get hit, my stocks are fine. Or my stocks do, go down, and everyone runs to bonds. So that was a little bit different when everyone opened statements last year. So wait a second, everything's down. There was no place to hide. And the difference, though, on the bond side is in 2008 when things went down. It went down because something went out of business. We had essentially credit issues. This one was a core interest rate issue, and that's when. So when rates moved, all bonds and treasury bonds, things are going to be essentially guaranteed by the government. They are going to pay you back, but they're going to take a little bump in between, and that's what happened there. So if I flip to the performance, and so we have right here, we've got the fiscal year number. Well, it goes essentially, total fund, the funds, the assets that we have in there, and by column, then market value, and then some time frames. When we talk about the bottom line, for you, we say the bottom line is the top line. We want to put your performance right on top. Then everything in bold are the things we hold in the portfolio. We put some italicized or some indices in there to say, okay, how did we do versus different items? And so when we go along that topic, say fiscal year to date, the stock market recovered on the backside and has been doing well this year, or well, it was positive this year. It's been certainly volatile. But fixed income still having its woes. And so you can see, but you have a positive return. It's essentially the mirror image of the last 12 months. So the last 12 months, you have negative 391. Where we made that essentially back up or positive that amount for the first half of your fiscal year, second half of 2022. And the differential here as you kind of go down that, if you're going to go on that 1 year page number for a little bit, you can see that negative. So we have benchmarks here that say intermediate in there, so you can see the sixes. You can see our number higher. Well, when you're talking about OPEB, we're talking about multiple decades. So we're you want to be a little longer than that when you're talking about the amount of time it's going to take to fulfill this promise, if you will, to the employees and fill this up. So we want to be a little longer, down a little bit more. I will tell you that the core or the aggregate bond index, and I got a slide in there later, was down 13% for the year. So far above where we would say the aggregate benchmark is. But certainly intermediate, and that's intermediate treasury only, but it lagged there, but through time, it is still beating that intermediate, and we would like to certainly having a little longer duration. Taxable, the diversifying, it's good that diversifying was a little better, and I'm still in that 1 year column. And if you look at the year to date, same thing. It's actually positive 2.18 year to date. All our diversifying fixed income assets versus negative return. And then being almost around, you call it 86 basis points better for the year itself, for the last year, is what you want. It's not, we've complained a little bit about diversification through the years, saying, wow, it's just been the S&P and core bonds that's really done it. It was great to see that at a time of stress, diversification worked. We didn't need the diversification when the stock market was up 19%, we don't need it to glum on 1 more percent and say, hey, yeah, look, if diversified assets did 20. That's great, but I would really rather what it did last year, diversity kicking in when the market was where it really needed it. So continue down that page. Obviously, international had struggles throughout. Yes, it was a little better on our end than the other, but and that was really, that's a currency issue. Everything was all things US dollar at that point. So it's not like those countries did that bad. It's the fact that you repatriate that money into US dollars and you take a pretty good hit. On the stock side, this is where it's really good for your core. I know we spoke last year and we were talking about different asset allocations, which we do, or maybe different manager searches, etc. I will say that one thing that helped was being in this process right here last year. You can see the total equity between diversifying assets and US negative just 92 basis points over the last 12 months. Your large cap funds or the core US, like or say the lion's share of the US equity, down just 0.01 versus the S&P 500 down 769. Significant outperformance when you're talking about trying to go through the S&P 500. As a matter of fact, that fund through the year of 2022 beat probably everything. It was in the top 7 to 5% of essentially US strategies or US funds across the nation. So kudos to you for the group. That you're in a good spot for the to get the call it, as we've been speaking about before, downside protection. We want to be at our best for you and for the portfolio when the markets are at their worst. And last year, when it was like that, that's when the stocks performed as we wanted them to. So big savings on that side. If you don't go down as much, you don't have to go up as much, which means you can take less risk. And then you can see that diversifying assets that I was talking about, not a massive number, positive 2.21. But if you can be positive when the market is negative, that's what we want to do. And we know those diversifying assets don't tie directly to the S&P. We just believe that through time we want to beat that. It hasn't been. We've beaten them up a lot the last really 10 years. If you go back in history, say from 2000 to 2010, when the S&P had essentially a flat to negative rate for the whole 10 years, being diversified was everything, or you essentially had no return. And then the next year, coming out of the great financial debacle of 08 and 09, everything has been really just a US centric return, or the real thrust of the return base has been from the US stock. So it's good that diversification is kicked up at that time frame. So which builds to solid, and then going back to the top again, you can see 3 years 593, 560 for 10 years, 557 since we started, and that's coming off a bad year. So prior to that, we were sitting there at the 6s. So that should reflect well to total long-term returns for the portfolio. When you get through a really bad year like that and you're still well above 5s, that's in good standing. And then that kind of goes in line if I'm going to talk about your actuarial statement. I like your actuary. Parker and his group does good work. I do think they were a little punitive this time with their discount rate, lowering it, and the fact that if you look at the long-term returns of assets, I think that they use a third party. They don't do it in-house. I think that the what would you say, the places that they use for Wall Street, and they use a lot of times State Street's issuance. JP Morgan puts them out too. The Wall Street tends to look 3 to 7 years, and they call them long-term outlooks. I would submit that a long-term outlook tries to look decades out or further out than that, because if you have 1% interest rates a year ago and you forecast out, I would think it's missing something to think that fixed income, U.S. fixed income, is really only going to earn 1% after inflation through time. So now that we're sitting at 4 to 5% in the investment grade universe, we're going to potentially get some more of those returns. So I think that I think it'll get fixed this next time around, and we'll see an upside. You'll see the balanced portfolio their discount rate for that to go back to the sixes, which will bring that long-term liability down, and that casts your will cast your funding back, I would say, from the, I think they were 48% of the last plus one right there, back to I would say really low 60s or high 50s. Certainly with the for the full group. So I think you are in great standing. You'll be in even better standing. So I jumped around a little bit there. Performance, trying to talk about what's happening. I have slides behind here. If you would like me to go to the next step about some economic color and what we've seen and how it ties to what we're seeing, but plan itself is, as I said, multi-decade. So it's really good information for now. But I'd love to talk more about the plan if you guys have questions. So would you like me to keep going or go to your questions?
Why don't we take just a quick pause and see if anybody has questions? And if no one has questions, we can plow forward. All right, Brian, why don't we let
All
you
right.
keep going then?
Sure. And probably just another 5 or so. And so look, page 6, this is the culprit that got us all here. And I don't know if you guys used to laugh like I used to, and I've been in this business for, oh goodness, it's been 30 years or so on now. We used to get a good laugh when every time the Fed said, "Yep, we look at core inflation," which is essentially or X energy and groceries, and we'd be like, "Really?" Because gas prices in grocery stores really don't matter to my paycheck every week. So why would you why wouldn't you want to include those? This chart really kind of shows why. If you look at the gold line, that's core, that's the core minus the less food and energy. I call it grocery, but food and energy. You can kind of see that you have to really see a trend like we did starting, well, back up at 2021 to really see that spike. The blue is if you just use core and you include those items. And so when you see these gyrations in the blue line, just think of the Fed saying, "Oh, we're seeing something," and it could, there's instances where, and I'm going to say back, I'm going to go back to a really calm period was 2006, and you can see that blue line dart down right there in the middle of it, and right there, everyone was saying, "Oh, Fed's got to act. Things are going wrong in the labor markets. We're having problems with prices," and essentially it happened for a month or two. And the problem with monthly data, it was 3 months later when they found out that there was essentially clerks and stop in well, if you're going to call it some clerks and grocery people in California were on strike. And there was a whole bunch, I think of the state of California, was a lot of people. Well, it was enough to stop moving the meter there. If the Fed went by the blue line instead of the gold line, they could have set the economy in spirals, because when they start moving rates. So what we want them to do is say, okay, let's collectively see things starting to move a little faster, and see what happens from there. I had the honor of just this afternoon, I was with a person that was a Fed chairman, part of the Fed decision board, that just got off essentially last year. So they were sitting there, and obviously the big question was like, how'd you miss this with this inflation? And they turned around and said, well, the problem was up until when you get to 2021, when you get right before that spike, the inflation in all other measures was almost under control, except for really the used car business. You couldn't get new cars, so used cars were spiked. So they were saying it was really almost one sector. And then in 2 months, boom, it was all sectors. And that was how they really got caught. And so they started chasing it after that. So you can see that it went up high. We don't have the 9 anymore. It's coming back down. And so right now, the term you always want to hear if the news or when you're reading is look for disinflation. And if you see that term, that's the term we're all kind of cheering for here. Disinflation is just inflation decreasing, essentially, it's still positive. It's not negative inflation or anything, but it's lowering inflation. We're looking to get that. We don't, and by getting disinflation, we don't have to get back to that 2% right away. That's where the Fed wants to be. It's where they've talked about a long time. But if they trend in that direction, we're looking year over year. So if we continue to get disinflation, then we can continue to move on. The Fed doesn't have to worry about the upside, because right now I can tell you they have to start worrying about the other side potentially. And that's the next one right here, page right here, 7. This is just the the wages and wage growth. If you haven't had wage growth, you can see in a long time, the joke prior, and I apologize, this is kind of busy. There's dates across the bottom, percentage across the top, and we're looking at unemployment is that gray one. You can see obviously that huge spike in 2020, and then wage growth. You can see how long wage growth was down. So that's how the stock market could move so well for a long time. And so I don't always shed these tears for these companies when wage growth is a little inflated, because it's nice to see people get wages. For a long time, as you saw, you can see the gray, it's like almost a slide going straight down from 2010 to 2020, and wage growth was still low. That we used to joke in the economic corner, say, yeah, anyone can get a job. You just can't get a raise once you get a job. And so that was the problem. So it loosened up a little bit. It's great to see that loosening up. Like I said, you want to cheer for the U.S. employee. At the same time, I will probably going to tell you that in having met with someone, that was with the Fed recently today, they are looking for that to shake up a little bit more. They don't want to go right back to where they were, because they need inflation to subside a little. So they want, you hate to say it, the Fed wants more layoffs, but they probably need some more layoffs to make the inflation, what I would call the wage inflation number, or the wage growth to calm down a little bit more, probably get a little bit more towards that blue dotted line. So when they want the big blue dot to meet the blue dotted line, and then they think at that point, they think they will be back more in economic harmony. I can skip 8. That's just what the Fed really did with rate. Actually, I will go 8 real quick because of the way the jumps go. When I talked about with fixed income before, if you look from where it starts, you can see back when Greenspan blew everything up and he just went one step at a time. It looks like those stairs to like the Aztec castles down in Mexico. All those little steps up, and then how quickly they had to take it back down. But they were just dropping it. They were raising rates until they obviously, I'm going to say the same term as what the Fed said this time. Fed essentially back in August, so we're going to raise rates till we break something. This was in 2004 going to 2008. That's what the Fed did. They raised rates until they broke the housing market. Well, they broke everybody. And so now going forward, that's the same thing that happened. The Fed came out and said, all right, we've got this problem. We're going to raise rates. You can see how quickly they did that. They did it last time from 2004 through to 2006, 125 basis points at a time. We didn't even get out of the same year. And they did all their rates. So that's how dramatic it was. And one thing I will state, and I've probably stated in too many meetings for Barbara, but too many people think that the Fed is doing their operations with a scalpel and scissors like they do in surgery. I'm here to tell you that they are using dynamite, and at smallest a crane. They are just putting dynamite, packing in a hole, and say, let's see what happens. They have no idea what it takes to slow down the economy with 175 basis point move of the housing market, because they don't know what price any of you on that side will not sell your house for, and what you will not buy one for. They have a general idea, but they don't know. So they have to keep moving it. And the other problem that I feel they were up against is it took about 12 to 18 months at least for that inflation to set in, and then they tried to fix it in about 6 months. You have to essentially let the amount of time that it happened in on the other side for it to unwind. So that's important to I think to know as well. And so when you flip to the next page, actually we're going to go the expectations of the Fed's moving too fast. So I want to go really to page 11. So this is what I was talking about, the fixed income market. This seems busy, but essentially what's going on here is you have the time going down along the bottom. You got percentage plus or minus 0 on the left-hand axis. This is the fixed income returns measured by the U.S. Ag, or all investment grade assets, investment grade fixed income assets measured by Bloomberg Aggregate. And so the negative dots down the bottom, they're essentially what the return was inter-year at any time. So you can see how low it might have gotten. And then the gray bar is where we ended the year in fixed income. So you can see it. Yes, you have a couple negative years, but you have nothing like we just had. 1976, they go till then because that's when they created this benchmark. But there's nothing in line like it was there. Now, the last time they had rates close to where we had movements close to where we were before is you go to this where this -7 and 3 are. That's 1994, where Greenspan unexpectedly raised rates in the middle of the year about 3%, blew up Orange County, if you remember the big municipal issue on the left coast. And that was a huge fixed income market. It was a negative market. It was obviously took people by surprise. This one did. The differential, you can see where we end up 3 versus -13 for core fixed income. That -3 happened because they already had essentially high interest rates before. So if you take the interest rates and you move them 3%, so you're going to have -9, but you already start with 6% interest, and now you get 3 more. Well, that's how you end up only being -3. Our problem this year was we went into the year with 1.5% interest rates in 2022. Then they raised rates for essentially what 3-4, but depending on where you look on the curve, 3 to 4%. So you got these massive, you can see right there, almost see at 1.17, they pulled it back a little, but still -15% returns, and you only started the year with 1.5% to fend it off. So that's why you had such negative returns. You didn't have coupon protection. So that's why I really like where the fixed income market is. Wasn't happy for anyone having negative returns last year. But now if we sit here with a base of 4% to kind of cross the low curve and go into, with credit added on there, you're about 5%. If the Fed has to unexpectedly move rates, we've got that cushion again. So we could take a full % raise in rates and not have negative returns for the year. If Fed does what they would like to do, which is potentially raise one more time, if not none, and then sit here as what they call their terminal rate, or to keep these rates as this level as long as they can, we would have nice 4 to 5% returns, which everyone would not really like. We want to compound at the rate as high as we can. Conversely, if we find that they've gone too far and they have to pivot to save the economy, or I don't want to say save the economy, but to save the soft landing, at that point, we'll get the returns back from last year because the yields will compress, those prices will shoot right back up again, and we'll be doing well. So I'm happy for fixed income investors right now to have core yield and that safety mechanism built in again. And just as a little bit of a offset, I'll show you what would happen on the equity on the next page, on page 12. The equity markets, we're a little used to having high negative returns midway through the year. You can see it's quite often you can see a return over 10%. You actually can see it's very frequent. You can even see over 20s or high teens aren't that outlandish. We don't end up there that often, but you can see during the year it bounces around, and it should, because of all the things that happen during the year. It takes investors a little time to digest them and see what the next move is. So you can see the return last year got as low as 25 negative on the far right, because it's time across the bottom of the return. Same graph as the bonds. You can see that we ended up essentially over 18% down. It says around 19, and we were as low as 25. And then right now we're positive. So you can see the ride that returns had. So given, if you put that -13 and -19, I'm very happy with how your returns have been over that time frame. We really kind of avoided a large negative market, and we still have the flexibility to be balanced now, and then we can always have those conversations as we move forward of how we want to flex of the portfolio, and we as the next actuarial statement come out, we can bring the actuary actually into the conversation. Just double worded, I apologize. Bring the actuary into the conversation and say, hey, what does it take if we go from balance to growth at some point? What does it do to the volatility? And let's see what it does to the discount rate which makes the funding rate go in line. Or do we want to say, you know what, we just don't want that kind of volatility, we can stay here? So good questions we can continue to have across the different groups. So I took a good bit of time there. Like I said, I still have more. People have questions of different slides in there, but at the same time, I want to make sure I want to be cognizant of your time.
Brian, if we stay at, sort of 5 to 6% rate of return on average, and continue to invest the amount that we're investing. Is there something that pulls together the actuarials and the rate of return and says, okay, at this point, we should be fully funded?
Yeah, and that's what, that whole actuarial statement that Parker puts together, has in line, he's got, I'm gonna give the terminal date for it. I was looking at all the number side. Right now it's set, well, he goes until I think he pays everyone off. Yeah, he goes all the way to 2096 to pays everyone off at 2080. So he's got, the last member. So what year does he have as his?
When do we start using the money to pay our?
Oh,
OPEB
yeah, you'll
off?
start, well,
We can look at that later. I just thought there might be
yeah,
a,
I'm trying to think of when
you know, what I'm trying to understand is the 5.5% rate of return what we need, or what we're sort of counting on to get us where we want to be?
Yeah, so I think it's it's low for the allocation you have, so it should be a percent. I believe it should be a percent higher, and I'm happy to have the conversation with him, certainly for the next time. And actually the next time they look at it, with rates being up, they might make it there on their own, but and also, and the reason why it's important is you're past being your funded level. You're past where the whole 20-year fixed income rate really matters as much. I mean, they can factor it in some, but for the most part, you're really going off of your long-term return because you're pretty far out. And so, and one thing have you put your funding plan in writing?
You mean, I have not seen something that would show that, but Brenda, do you?
We do not have it in writing. No, we do not.
Okay.
I would, if it's kind of, if what you have in line is plans to be regular and repeatable, I would put that in writing. So when the actuary comes in and say, hey, this is what we plan on doing, they understand that there may be a time when you may or may not make it, but they don't, because of the way the economy works. But overall, if you can keep on doing that, that helps them because they take the contribution piece and they can fill that in through time.
Okay.
So that certainly helps.
Okay, thank you. Good information.
And in terms of looking at this presentation, I guess, and thinking about where we're going in terms of the setting up the actual trust agreement and the board of people making the decisions on that, do you see the recommendation of Rockland Trust changing very much in terms of how we're investing?
Well, what I usually tell people is, and because so many municipalities are usually much less funded than you are, most municipalities, I mean, it's usually, as you said, associations such as yourselves is pretty good, and some like the utility plants, et cetera, are at that level, but most of the cities and towns aren't there yet. So with them, I say, hey, you're gonna have to get there sooner or later. So why don't you start being, more aggressive? It really comes down to, well, I think first we bring the actuary in and we ask them that question, say, hey, can you run this one notch up? First of all, like, why'd you do this one so low? But, and then because they can do the scenario analysis, if we went up to, the next level of 75-25 stock to bond, how does that help the portfolio right now? Where do you have your returns? It should take it up essentially, I think, another percentage. But I believe this one should. I think the balance should be around 640, 630 right now as the long-term return, which makes the growth one in the 7s. Because you're talking about long-term, we're talking about decades, we're not talking about years. So at that case, for every percent that your discount rate goes up, your long-term liability goes down about 15%. So it gets you there, gets you a lot closer. So if entities can handle the volatility that comes with that, remember, if you go 75% stock, that's a different return than it is, I hate to talk about. That's why last year was decent having a negative year, except for the bonds went down. You want to see a negative year that wasn't 08, because we're like, okay, if you had 08 and you had 3/4 stocks, that was quite painful. But if the entity can say, okay, guess what? We took that and we got that punch in the nose, but we know that because of the long-term expectations, we're still going to get there. And the actuary should know that as well. That you'll see your numbers dip after it, but after that they'll say, okay, this will dig us out. If everyone's comfortable with that, then moving to that allocation makes sense. Because you get there, but as long as if it's gonna make people uncomfortable when the market's down like it was last year or any other year, to the point where it's difficult to get the funding. So that's what's key, and that's why I said it's written, but we want it first in written, and then you want it closer to stone than in pencil, I guess is what I would put. Because if the funding rate can evaporate or be tarnished or be taken apart after the market goes down, then it's not worth to get the allocation, because the funding is you only have two ways to get money. It's either with contributions or there's market return, and obviously there's the cost side, the lower liability. But so what we want to do is when everyone's comfortable, then you can step up, because you don't want the contributions to evaporate.
Brian,
Right, so it goes to whether or not you see whether or not we would be more reactive or whether we'd be able to stay the course.
Yep. So you have an IPC, you get a trust. I mean, an IPS, you get a trust. You say, okay, guys, we're all signed on with this. We're comfortable with it. We're comfortable with what we have, or we're going to be comfortable knowing that the stock market, because we don't want to move if you get more aggressive, you don't want to get less aggressive again because of the markets. You'd only want to step back as you say, wow, the funding got so great, and the actuary's numbers say, hey, wow, we really only needed a 6 to get there, and get there in short time frame. We don't need the 7.5. Sorry,
Becky, when Brian's saying put it in writing, and when he uses the term IPS, that's in reference to an investment policy statement.
Yeah, and I don't know if that is part of our trust planning.
You do have an investment policy statement. And so it's just a core saying, all right, we're gonna stay in line with this, and it's more if everyone's comfortable that they wouldn't want to move, because that's the hard part. When something's in writing, you can still change it. So if people were going to move because they didn't like how the market was, or they were tempted to, what Barbara talks about is trustee risk. That's what we want to essentially eliminate. We want to get to the point where if everyone's comfortable enough with how it moved when it was balanced. Hey, if it had a little bit more volatility, would we be all right if the actuary comes back and says, hey, let me rerun the numbers for you, or rerun them, give you an estimate of what it looks like if you got more aggressive.
Okay. I see that it's actually 6:34, and we do need to do our internal financial review. So if people don't have other questions, I think we may have to sort of leave it at, we've gotten a lot of really good information about the markets in general and about our own portfolio. And if people don't have questions, I think we'll thank you guys very much for the information, and let you come back with more information when we speak to the actuaries, or we actually need to make some investment decisions.
Yep. And if you'd like us to reach out to Parker on your behalf, just send us an email or call us, just let us know, and we're happy to do that. And the same thing to be thoughtful of your time. We can end now, and then we can just get on, any one time your guys are meeting again, hopping on like this is pretty easy. So we're happy to continue the conversation.
All right, thank you, Brian. And we probably should touch back with, have Brenda and Charlie and Mary talk about that as well, to see if we want to create some action items.
And I will make sure that I reach out to Brenda to update the signatories on the account.
All right, thank you, guys.
All right,
Thank
thank
you.
you. Have a great evening, everyone.
Yeah, great to
you.
see you
Thank
guys
you.
virtually.
Thank
Have
you.
a great night.
Thank you.
So Brenda,
Yes.
we'll come back to the agenda item we left when we went down this rabbit hole. And let you take us back to, oh, that's an interesting slide. Let you take us back to the February financials.
Okay. All right. First up, at the end of February, we were in good financial condition with an 8.99% budget surplus, which is up from last month. Statement of expenditures report shows total expenses for the month of $164,594.57. Cash position report shows income for the month of $176,935.02. Disbursements for the month were $233,605.23. The total cash available at month's end was $1,217,094.86. OPEB account had a loss of $21,686.45. Bringing the ending balance in the OPEB account to $931,463.34. Budget resources report. Total receipts for the month, $176,935.02, brings the total year-to-date receipts to $2,611,079.82. AAA report. Outstanding balance for AAA pass-through programs is $1,020,498.22. Outstanding balance for AAA admin and ombudsman programs is $166,868.93. This brings the total outstanding balance for AAA programs to $1,187,367.15. Voluntary transportation account beginning balance was $175,453.86. Restricted fund payments to volunteers were $842.98. Donations received were $304.50, bringing the ending balance in the fund to $174,915.38. ROM statement and activity. Balance at the beginning of the month was $170,443.86. Receipts for $7,850, bringing the total receipts to date to $50,800. Expenses were $9,660.16, bringing the total expenses to $58,709.48. The ending statement balance was $171,274.04. Budget spend down report. Page 1, total expenditures were $1,430,909. The spent to date percentage rate at the end of February was 57.73%. The ideal percentage in the 8th month of the fiscal year would be 67.72%. So at month's end, we had an 8.99% surplus. Page 2, budgeted income shows no changes at this time. Page 3, pass-through income shows no changes at this time. We definitely, those pages will, by the way, change next month because we do have some new grants that needed to be added in. I just have not added them just yet. Next up is the list of combined AP and cash transfers. And that's it for the OCPC financial reports.
Thank you, Brenda.
You're welcome.
Do we have
Anybody have any questions?
Yeah, that's what I was going to say. Do we have any
Sorry.
questions for Brenda, or
No.
do we have a motion to accept Brenda's financial report?
Motion, so moved.
I'll second that.
Thank you. Megan, could we do a roll call?
Sure thing. Abington,
Accept.
Bridgewater,
Accept.
East Bridgewater.
You get to leave.
Yes, he did. Kingston,
Accept.
Pembroke,
Accept.
Plymouth.
Accept, and I'm sorry, but I have to log off now too, so.
Thank you, Lee.
Thanks,
Okay.
Hi,
Lee.
Lee. Thank you.
Plimpton,
Accept.
and at large.
Accept.
Thanks.
Could we check the call-in number ending in 099? Is that Frank staff here?
I do not know.
Frank, is that you?
Is Sean on the meeting?
Yes, he is.
Okay.
Oh,
Yeah, I don't recognize that number as anything from Frank.
it's Sean. Sean's talking
Sean's
through.
on there twice, yeah.
That's, yeah. So it's Sean, you're on there twice.
That's what it is. Sorry. My audio, my computer audio wasn't working, so I had to dial in.
Okay.
And now we know.
Uh-huh.
Okay, that
Um,
is
Going back to
roll
mute.
call.
So I know that we went long on the Rockland Trust item. So as we look at the preliminary FY24 budget process, we also have an action item on the Brockton Improvement District. So let's see if we can rely on folks to spend a little time offline looking at these. And Brenda, if we could just do the highlights.
I don't have the details on the BID because I think it was scheduled for Mary to do that report and on my.
Yeah, I can cover that.
Oh, okay,
Thank you
yeah.
so
But
much,
before we
Charlie.
go to that, included in your handouts was the FY24 budget process. Brenda, you had already put together some numbers and initial estimates. It looks like the new budget might be about $200,000 more than FY23. And then also included in your package was a Wright Technologies IT assessment. And since they've come on board, they've done a lot of work and made a lot of progress and really upgraded our overall IT experience and safety and backup and recovery. So, kudos to Wright Technology. So that's been great. But I just wanted, just for the record, to say that for the board.
Charlie, on the fiscal 24 budget, when you said it was going to be up around 200,000,
Yeah,
is that 200,000 that's covered by additional grant money, or is that just using up some of the surplus we had this year?
it's additional grant money coming in. The staff under Mary's direction has been very proactive about searching out new opportunities for funding, and they've been successful in securing new funds. In the MassDOT side, that's going up. But we also secured a Safe Streets for All grant, community planning, got a watershed grant. So, a lot of kind of new money's coming in. So it's a really exciting time.
Great,
Also,
thank you.
The surplus funds do not roll over. It starts, the numbers for FY 24 will be standalone based on the income and expenses based in that year. It does not roll over. It sort of stops and starts over again, if that makes any sense.
No, it does. I think I was being loose with my language too. I was
Okay.
thinking if we had surplus this year, if we had the same amount of income and the same amount of expenses, we'd have a surplus again next year.
Understood.
But if we look at that line item, we are somewhat planning around a somewhat lower surplus.
Yes, so
Right.
far, but that's going to change because we have a lot of income that's not yet hitting the income side of this budget. This is a very early preliminary budget. So it's going to change a lot.
Okay, then I think it does make sense, given our time, to look at the Brockton district, because I know we have a decision to make on that tonight. So I'm sorry.
So through the chair, I can say a few words about that. And I know Mary had provided a flyer, an informational item to the board members in advance as well. So the
Yes.
Business Improvement District is a mechanism enabled by Mass General Law, Chapter 400, for property owners to come together to establish such a district to go above and beyond what a community can offer for services. And through the legwork of Mary and a team, they've come up with this proposal to create a BID, and with a proposed budget of $700,000. And what it includes is a property assessment. And for OCPC ROM, it would be $1,571. And what this would focus on is beautification, marketing, advocacy. There would be a cleaning team going around the core district to, beautify, pick up trash. And there would also be different opportunities working above and beyond what the city services can provide, and also the Regional Chamber of Commerce. And, it's been successful in other areas, and, it's a staff's recommendation that to approve this.
I think it's also worth noting that when you look at the fact that we'll be renting some space, it also makes it a little bit easier for us to invest in the space and the quality of the property we have in the surrounding community for that property.
Mhm.
Charlie?
So do we have
Madam-
any questions about it?
I think
Yeah.
Val has her hand up.
Yeah, if I could, I'm sorry.
Of
I
course.
was, that does now, like, in my preliminary discussions with you all, doesn't that also, like, we already have money that we're setting aside for some of these activities, so by partnering with the other communities on this, or excuse me, your neighbors in the business improvement district, you're allocating some funds that are already used in the operating budget towards this, and it's sort of synergy or multiplying the value of that money in terms of how it's spent. Is that a
Yes.
good?
Yeah,
Okay.
no, that's a great, I wish I would have thought of that. That's a great way, the multiplier event, and it helps offset the costs that we're already putting out there for some existing efforts. So it is the multiplier effect, definitely. And I really like the term synergy with your co-property owners, and just because you believe in the improvement district, and it's everybody working together.
Yeah. So I think that kudos for Mary to, have gotten that going, and I recommend it as well, just with the preliminary conversations I've had with the group. So just wanted to offer that, and thank you.
So do we, who would know whether we actually take this up and approve it as part of the Finance Committee meeting, or do we need a break into the ROM committee meeting to approve this?
I believe it's both, because both, I believe, ROM and OCPC. Charlie, am I correct?
Yeah, I was just checking to see how it's labeled as an action item on the regular finance agenda for you folks right now.
Yeah, I think it is both.
Yeah, I believe that
Okay.
we have to recommend bringing it to the council to vote, and then bringing it to the ROM council to vote.
I think that's right.
I see that now. So
Yeah.
do we have anybody who wants to make a motion?
I'll make that motion.
Okay, so the motion is to support our participation in the Business Improvement District, and to suggest that the council approve the assessment.
Yes.
Do we have a second?
Second that.
Thank you, Stephen. Okay, Megan, could you do a roll call of the committee?
Absolutely. Abington,
Accept.
Bridgewater,
Accept.
East Bridgewater left, Kingston,
Accept.
Pembroke,
Accept.
Plimpton,
Accept.
at large.
Accept.
Thank you.
Okay, I think that allows us to adjourn the regular council Finance Committee meeting. If we, and switch over to the OCPC ROM Finance Committee, do we have a motion to adjourn the first meeting?
So moved.
Second.
I think we generally take adjournments just by hand. So I will just go ahead and call to order the ROM committee, Finance Committee meeting, which is essentially the same committee members. It's now 6:51, so we're starting a little late on the ROM committee meeting. This meeting is accessible to people with disabilities. Microphones or telephones will be used by all speakers. Large print materials are available upon advance request. If you would like either of these accommodations, please contact Mary Waldron at 508-583-1833. The notice of non-discrimination rights and protections to beneficiaries with regard to the federal Title VI non-discrimination protections and the state non-discrimination protections is posted in the meeting room and is available on Old Colony Planning Council website. Please contact Mary Waldron at 508-583-1833 for more information. Thank you. So with that said, we have to roll call for this meeting.
We will go back to the original first, just say if you're a delegate and present. Sorry, Abington,
Delegate present.
Bridgewater.
Delegate present.
Sorry, Charlie, do I need to say all the towns again for Rom?
Yes.
Okay, sorry, one moment. I just need to start that over again. So
Is that true even though it's a committee? Charlie?
Yeah, well, if we know just who's here, I would just call those names.
Okay, all right, so I don't need to do it. Okay, so sorry. We did Abington, we did Bridgewater, Kingston,
Present delegate,
Pembroke,
Present delegate.
Plimpton,
Present delegate.
at large.
Present delegate.
And I know Alex Haggerty is here as an alternate for Abington. And for OCPC staff, we have Charlie Kilmer, Brenda Robinson, David Klein, Sean Noel, and Megan Fournier.
Yes, okay. So now we will go over the preliminary FY24 budget process and the OCPC management fee, which is an action item.
Okay, so we are putting forward wanting to increase the management fees from 7,500 to 10,000 annually, which is an increase monthly of it goes from 625 monthly to 833 monthly, and that's with managing more of the building with the right technology and that whole piece. So that's pretty much what that management fee increase is about, and that does require a vote to approve.
Okay, and I will note that I'm looking at our income going up 30,000,
Yes.
and our expenditures are still only going to go up like 4,500 maybe.
Yes.
So we can
definitely, yeah.
afford this.
Mhm.
So do we have a motion to recommend, because we're just the finance committee and it'll go to Rom tomorrow night. Do we have a motion to recommend that increase?
So moved.
Thanks, Christine.
You're
Do we have a
welcome.
second?
Val
Second.
second,
Thank you, guys. Roll call on that, Megan?
Abington,
Accept.
Bridgewater,
Accept.
Kingston,
accept,
Pembroke,
Except,
Plimpton,
Accept.
at large.
Accept.
okay, we sort of jumped the gun in some ways on that because I guess our next action item is to approve the Right Technologies lease agreement.
Yeah, so I'll speak to, so if you scroll down a little bit, Megan. So obviously, Right Technology remodeled the back area, and Right Technology uses that as their headquarters. And we've entered into a proposed a lease of 2,500 per month for 2 years with a third year option going up to $3,000. So basically that increase in the management fee, which you spoke to under your previous agenda item, would be covered by actually the lease with Rice Technologies as a funding stream.
Okay, do we have a motion to approve the lease with Right Technologies or any questions about that?
I'll move the lease.
I was
Thanks,
second.
Val. Thanks, Stephen. Roll call, Megan?
Abington,
Accept.
Bridgewater,
accept,
Kingston,
Accept.
Pembroke,
Accept.
Plimpton,
accept,
at large.
Accept.
So next on the agenda is another action item. Since we all heard the discussion on the Business Improvement District Assessment, this is for ROM to ROM's Finance Committee to support the Business Improvement District Assessment of, what was it, 1,500 and
Yeah, 1571.
1571. Do we have a motion?
I'll make a motion to, for that as indicated by you.
Thank you, Sandra. Do we have a
I'll
second? Thanks,
Yes.
Val. Roll call, Megan?
Abington,
Accept.
Bridgewater,
Accept,
Kingston,
Accept.
Pembroke,
Accept.
Plimpton,
accept,
at large.
Accept.
Thank you. I realized as I was looking at our agendas on my other, that we did miss talking about the Right Technologies. Oh no, I know what we missed. David was going to talk about the EOEA reversions, and that was supposed to be part of our OCPC agenda as opposed to the ROM agenda. David, I think we may have to take that up next month, unless you want to just real quickly give an update.
It's 20 seconds, and I know people can't believe I would say anything in 20 seconds, Becky, but
Amen.
but literally what happened was a report came out that the Executive Office of Elder Affairs had left about $2 million on the table in grant money for elder lunch funding. In other words, they didn't even pass the information about that grant money on to the AAAs and the aging service access points. Mary thought that it was important for us to be aware that that occurred. And I think the reason it occurred had something to do with a lot of turnover over the past 2 to 3 years, and a huge amount of income that came in besides the regular Title III money, mainly the CARES Act money and the ARPA money. So it's not, it's that middle bullet point that you've just put up, where Aaron Bateman, who's the current CFO, wasn't even there when this was occurring. And there was, and the second to the bottom bullet point, where there was such a large incoming amount of money that came in that it was just hard to keep track of. So, but I think, it was just a matter of Mary wanting the board to be aware that something like that happened, and that it could happen where you wouldn't think it really would be able to happen. That's
Well, and I guess the services were probably still being provided because of other monies. And so people, that maybe could have been some additional programming, but the basic programming was all there.
right. And I mean, I can put that in perspective for you. That $2 million would have meant maybe about $80,000, $75,000 or $80,000 to our to the OCPC area, but that money would have gone directly to Old Colony Elder Services, and Old Colony Elder Services spends about $4 million a year on nutrition.
Okay.
So it would have been way less than 5% additional money for them.
Okay.
The other thing I think it's worth people knowing about is just that there was some talk about going back and trying to pull the money into the programming, but there's some other legislative priorities that the area councils on aging have. Is that right, David?
Yeah, that's right, Becky. You're on target there. The aging service access points and the area agencies on aging as a whole, there's 20 some of it, such agencies like us, feel that with a new governor and a new legislature, this is just a lot of noise that the legislators wouldn't understand unless we forced them to understand it, but that would take up valuable time and space for them when we really want them to understand what the legislative priorities are in the first place.
Okay. Thank you for that update, David. If I think that's our last agenda item. So unless I missed something that someone wants to bring up, I would entertain a motion to adjourn at 7:01 p.m.
Motion so moved.
I'll
Thank you,
second.
Susan. Thanks, Stephen.
Thank
All in
you,
favor?
everyone.
Aye.
Thank you. Good night.
Is that by?
Night.
Bye.
Night.
Thank
Good meeting,
you.
guys. Good night.
Good night.